Welcome global citizen. We are tuned into the matrix version of Money Matrix Venus. We are tracking complexity of Asian to European, American to Japanese markets. Every number tells a story. Number is a game. We are clarifying clarity and conviction of global economy. I am Satvik Kamath. Subscribe to my channel. Market Bets No One. Ever wonder who really controls the flow of money in your economy? Who pulls the lever that affect your mortgage rate, the price of your groceries and your investment portfolio? It's not local bank. It's a powerful, often secretive institution, the central bank. In this video, we were diving deep into uncover what central bank are, who the major players are, their immense power, and why every trader and investor must pay attention. Let's get started. What is central bank? So, what exactly the central bank? Think of it as the banker's bank and the government's bank. Unlike commercial bank, which focuses on profit and serve you and your business, a central bank is a public institution focused on one major goal: macroeconomic stability. The monopoly. They have a monopoly on increasing the monetary base, meaning they are the sole issuer of coins and notes. Major responsibilities: the toolkit. Monetary policy. This is their core function. Their primary goal is often to maintain price stability, usually defined as keeping inflation low and stable. They use tools to manage the cost and supply of money, setting policy interest rates. They set up the rate at which commercial bank can borrow from them. This influences the cost of borrowing across the entire economy, from mortgages to business loans. Regulating money supply through open market operations, buying or selling government securities, and setting reserve requirements, how much cash banks keep on hand. They control the amount of money flowing in the system. Financial stability. They act as the lender's last resort if a commercial bank faces liquidity crisis. The central bank steps with short-term loans to prevent the bank run and a systematic financial meltdown. Bankers to the government. They manage the government's accounts, process its transactions, and issue government securities. Major central bank in the world. While almost every country has one, few central banks have an outsized impact on the global financial system. The Federal Reserve System, Fed. United States, US dollar is the currency, dual mandate, maximum employment and stability prices. European Central Bank, ECB, Eurozone, Euro is the currency, primary objective is price stability, inflation target. Bank of Japan, Yen is the currency, price stability and maintaining the stability of financial system, known for persistent ultra low interest rates. Bank of England, United Kingdom, pound sterling is the currency, monetary and financial stability is the key focus. People's Bank of China, yuan is the currency, monetary policy and financial stability with greater government influence. These institutions often coordinate, but their policy decisions diverge, creating massive shifts in currency and capital flows. Impact on economies, monetary policy in action. The central bank's policy decisions directly translate into changes in your economic reality. Tightening policy. When inflation is too high, the economy is overheating. The action. The central bank raises interest rates. The effect. Borrowing becomes more expensive for banks, which pass the cost to consumers and businesses. This slows down spending, reduces demand for goods and services, and aims to bring inflation back down. The risk here is triggering recession. Easing policy. When the economy is weak or in recession, low employment, risk of deflation, the action. The central bank cuts interest rates. The effect, borrowing becomes cheaper, encouraging consumers to take out loans, mortgages, credit, and businesses to invest and hire. This stimulates spending and aims to boost economic growth and employment. The risk is fueling excessive inflation or asset bubbles. It's a constant, delicate balancing act, a high-stake game of economic engineering. Why central bank matter for traders and investors? For anyone, the markets, whether you are a day trader or a long-term investor, central banks are the number one driver of market volatility and trend direction. Why? Interest rates and asset valuation. The central bank's policy rate is the risk-free rate. It's the benchmark against which almost all assets are valued. Bonds. When interest rates rise, the price of existing bonds generally falls, and vice versa. Stocks, higher rates increase borrowing costs for companies and make the future value of the cash flows less attractive, often leading to lower stock valuations. Real estate, higher mortgage rates directly impact housing affordability and prices. Currency markets, Forex, central bank announcements are the primary catalyst for the largest moves in the Forex market. A country's currency typically strengthens when its central bank raises rates, as makes that currency's assets more attractive to global investors. Market sentiment and forward guidance. It's not just the action but the words. Central banks use forward guidance, communicating the future policy intentions to manage market expectations. Traders and investors hang on every word of the Fed chair or ECB president. Unexpected statements often cause abrupt, significant market movements. The future of central banks, new challenges. Central banks are not stuck in past. They are currently navigating massive structural changes that will redefine their role. High public debt. In many advanced economies, governments can carry massive debt loads. Central banks face pressure to keep interest rates low to make government debt servicing affordable. Even if inflation is high, a tricky political and economical dilemma. Digital currencies. Many central banks, including the ECB and the Fed, are actively researching and developing central banks' digital currencies. This would be a digital form of the fiat currency, potentially offering safer, more efficient payment system, but raising huge questions about privacy and the role of commercial banks. Climate change. Central banks are considering climate change a source of financial risk. Example, impact on bank balance sheets from extreme weather. This is pushing them to incorporate environmental factors into their regulatory oversight. Here is an interesting quote of Finance World. Inflation is the form of taxation that can be imposed without legislation, by Milton Friedman. He was the Nobel Prize winning economist. He is famous for advocating free market capitalism known as monetarism, shaping modern economic policy. That's all today. Don't forget I have a Venus version also, covers world fashion. Let me know the comments. Do you think central bank have too much power? Don't forget like, share and subscribe my channel. See you next time.